Hello and welcome to Options Guide TV. Today is Monday, December 11th. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host here for about the next 25 minutes. With that said, I'm going to start off right away by letting you know that if you do see a chat box, if you put something in there, we'll try to address whatever that something is. So this is a very interactive show. We do it live with live markets. And if you want to participate, all you got to do is join in live. We do this every Monday, Wednesday, and Friday at 11 a.m. Eastern time. All right. So I'm going to start today by looking at a very popular strategy inside my book on the book's website, theoptionsplaybook.com. So let's go to Options Playbook right now. And we've been building out a portfolio of stocks using deep in the money calls as a surrogate for owning the stock. So this is the optionsplaybook.com. If we go to option strategies and we go to the veteran strategies, we see a little trade called the fig leaf. Okay, now at one point in time, this strategy used to be called a leverage covered calls. Sometimes I heard them called a synthetic call. It's really down on the floor, a leaps diagonal. But I thought it needed a name, so I named it the fig leaf because you're using the stock as a surrogate, or you're using an option as a surrogate for the stock. So you're buying something that's deep in the money. It acts a lot like the stock, but it's not exactly the stock. And then we're selling a shorter term call against it, just like you would if you had a covered call position on 100 shares of stock that you actually owned in your portfolio. So we like to say it's the fig leaf because you're kind of covered. You have something that acts a lot like the stock. As far as the brokerage firm is concerned, you are covered because you have the right to buy the stock at a lower price than where you have an obligation to sell it at. But with all of that said, if you do get assigned, you have an option contract that is in a short-term expiration, and you have a long-term expiration that's deep in the money. So you have a situation, and that situation means that you got to do something. You either got to exercise that deep in the money call option, which usually doesn't behoove you to do, or you got to go out and get that stock and give it up for that assignment. Hence the name, the fig leaf. You're kind of covered. So I'm going to go into a little bit more detail because I'm going to start building out this portfolio today. I guess we'll go a little bit of a summary before I get into details on the fig leaf, but this is an important week in the markets, as most are, I guess, but we do have CPI tomorrow. We had some strong jobs data and wage growth, solid wage growth once again. And it'll be very interesting to see if CPI is tamed. The retail consumer, the worker, the person that's buying Christmas gifts this holiday season, that person is really keeping the economy running, and we're just staying afloat. Everybody's saying that the soft landing, it looks like we're going to pull it off. Talking about cutting interest rates in March, as soon as March. At least the CME Fed Watch tool is implying we might get a rate cut. So CPI tomorrow is going to be very interesting to see. It would be really nice if it does actually go down a little bit, and that would show that the economy is slowing, even though we're still having solid jobs numbers and employment numbers and wage numbers. Okay. Then we have the Fed. Then the Fed's going to have their meeting and their notes on Wednesday. And I think everybody's going to be asking a lot about the potential cut in the Fed funds rate and trying to get any hints from Powell if he's going to be a little bit less hawkish on the marketplace and want to actually hint that it's feasible that we might get a rate cut sooner than later. I think that's the biggest thing that we know if you look at the Fed Watch tool, you know that there's a very low probability that anything is going to happen at all, right? The rates are going to stay right where they're at. And so it's all going to be about the tone of the comments afterwards. Okay. So we have a portfolio of deep in the money call options, and we've sold some calls against it. Inside the paper trading portfolio of the TradeHawk software, which is awesome that we're able to trade inside that with fake money, and it's acts exactly, almost exactly like the actual TradeHawk software site. And we just started by taking a couple of small positions in 4 different stocks. We're going to add to those positions today. And then we're going to start selling some call. We got one stock that's in danger of being assigned. So we're going to start managing that position and selling some more calls against the new option contracts that we have. So if I look at the fig leaf inside the playbook, here's what 2 things that kind of jump out inside the strategy. You'll see that our goal here is to purchase a long-term call option. So we're going all the way out over 400 days in time, and we're going to purchase a leaps option. And we're going to go deep in the money, deep enough that we're going to get a delta that's fairly close to 80, meaning that if the stock goes up 1, your option contract should go up about 80 cents. This will be a real option. We'll spend about 20% of the stock's price when we're buying this deep in the money option. And that's been the case with the option contracts that we bought already. We will then go on out and we will sell a shorter term option against it. So then we're going to go out and sell that call option, and we'll probably do that on the show. We're going to look at the markets. I always like to do things in real time, so I don't have everything set up exactly what we're going to do. We're going to look at it, go through the thought process, and decide if what call options that we want to sell against our leap option contracts. And then you'll have on your fig leaf, otherwise known as a leverage covered call. And I think that that's probably the most technical name with it, but that's a lot of words. I like to just say fig leaf just in overall. And so let's do it. Let's get into the strategy. So I'm going to take a second here to jump back to the TradeHawk software and full screen. All right, so now we're in the paper trading portfolio. These are the deep in the money call options that we have. And Charles Schwab, we said this on Friday. We were thinking about rolling this position on Options Guide TV on Friday. The strike in our portfolio is at 64. So we're in the money on that option contract. And it looks like we're in the money also on the CAT option. And I actually didn't notice that until just now. So CAT is at 261 and we're 255. We're going to have to, we got 11 days remaining. That's a danger Will Robinson right there. So we're going to start by rolling that one. Then we're going to look at rolling the Schwab one. But you notice that green means in and red means, red means that we're in the money closer to expiration. So that's highlighting the number of days that are remaining to the expiration. And also on Schwab, we got 4 days remaining on that one. But that's going to be an easy one to roll, but we got to worry about this one. But the portfolio just in general, you notice that that option contract is up about 31%. We're down a little bit on the Google, or not a little bit, in the options world, it's 20%. Up on the Nvidia call option, 520. And yeah, we're looking fairly safe on that Nvidia call option, so I don't think we're going to do much there. We got expiration 11 days away on that one. And then Charles Schwab, we're right at the money, and we're going to have to do something. I don't want to mess around with it being that short and that close to the expiration date. With only 4 days remaining, we're going to have to roll that one. So now this one's going to be a challenge. So let's look at this portfolio, and I think we're going to add to this position today too. We're going to at least add a few of these option contracts and kind of leg into our positions. We put these on initially at the end of October going into November. We're now in December. We're just going to add some more to the portfolio in general. And once again, it's a paper trading. It's not meant to be a recommendation. We're just going to try to manage this portfolio throughout the year and, see what happens. I haven't been able to do this. I used to, when you work for a brokerage firm, you really didn't, with all your licenses and that, it was hard to try to actually manage a portfolio live. People would argue about if that was kosher to do. And now that I am independent, I am able to address this a little better. So we'll be able to build out this portfolio, and I think we're going to have a lot of fun doing it, honestly. At least in my world, this is fun. Okay, here we go. So on Caterpillar, let's just go to Caterpillar. Let's make note of the strike that we have. We got the 12/22 expiration, and we're selling the 255 strike, and it will show us that. And we're going to go back to the options grid. 250. I had Schwab up because I was thinking we are going to start with Schwab, but we need to start with Caterpillar, especially with the stock up $2 today. So it's starting to run against us. And 12/22, go all the way back. Here's that expiration. It shows you 11 days remaining to that expiration date. We are short the 255 call option, which is right here. That means we got extrinsic value of $2.25. So there's still some premium in this. And we're going to want to buy that back and close that position. So we're going to click on this and click on that ask price. And notice it puts in buy to close. And then we're going to try to roll out in time. So we're going to look for some decent premium. 875. Yeah, we're going to be tough on this trade. So let's go 772. All right. So on here, 875, we're going to have to go up to January. See, this we waited a little bit too long to roll this position. So now we're talking about going to the 260 level. We're at 550 on the 265s. We're going out 32 days in time. And if we go up to January, now we're at 875, but now we're talking about 39 days. We're at the 260 level. Gosh, we might just want to close out the position. We maybe are a day late and $1 short on the roll, but let's roll it. Let's just do it. We're gonna go out to the 39th expiration. But if we're gonna do this, we would have to, if we sell an out of the money option contract, in this instance, we are bringing in $4.30, and this is really going to cost us some money to do the trade. We could do the at the money, which this is right at 260. So at this point in time, we could sell this at the money option contract and hope that the market came down. We'd have 39 days for the market to sell off a little bit, or we can go into our portfolio and we can close both positions. We had a good solid run up on the underlying stock. We're profitable on that. We will be a little bit underwhelmed on the 255, but the fact that the stock is up a couple of dollars today and we're 6 points in the money really hurt us on this short call position. So let's close it. I think I'm going to close it. Going all the way out to the options grid, I don't know if I want to roll and still hope that it's going to come back down to this level. And if we don't, then we're going to have to pay some real time premium to maybe go up to the 270 level. So at this point in time, I'm going to take that position off. And I could see putting a new position on, but we're going to wait on the stock a little bit more. So let's buy to close that, and we're going to sell to close this one. Close at mid. Uh, 210, 1770. And the options grid, 210, 17. Let's go all the way out to the January 17 expiration, and we're going to sell the 210 call option. All right, so we're going to be placing an order to buy to close the 255 strike call, and at the same time sell to close the 210 strike call. We'll be bringing in a net credit of $58.25. We'll probably give a little bit of that up. We'll see if we can sell this for 58 net credit to the account. Let's put it right at that. And we're going to send this to the trading floor. It is a paper trading application, so you never really know about the fills on the trades. So we're going to send this order and close, and there we go, and hit send. All right, so now we're working our first order to close out our position. All right, we did fill. So the app sent it to the floor and said it's within that feasible midpoint range, and so we're going to fill it right at that 58. So that position is off. So now let's go back to the portfolio and let's save our Charles Schwab position here. So in this instance on Charles Schwab, I want to clear this out and take this trade and say trade, and let's roll it. Okay, so now we're going to roll from, let's go look at the options grid and look at the Schwab position, the SCHW. So we want to roll this trade, the 64 strike, 12.15, 4 days away. 12.15, 4 days away. And we'll probably, hopefully we could go to the 11 strike call option and be all right with that. So dollar for, and I'm sorry, the 22 expiration, 11 days away. And that's 144 and that's 190. Okay, we're close. We're going to have to go out to 18 days and get up to the 65 level. All right, so then the expiration that we're going to look to, we're buying to close this one. We're going to sell to open the 64 strike call and bring in a net credit of 62 cents. And let's see if we do the 60. Yeah, we got to do the 65s in order to pull that off. But I think that's where we're going to stay. Net credit of 11 cents. All right, so we are buying to close the 64 strike call that's going to expire on the 15th, and we're going to sell to open the 65 strike calls that are going to expire on the 29th. We're going to hit send, and it asks you, we're going to send you a short diagonal spread with calls. The answer is yes, and we're trying to do it for 11 cents. And we look over here. Can't quite see it, right? But it's showing that it's filled, but my ugly mug is right in front of it. So we filled that position. And if we look in here now inside our portfolio, we will then eventually see that this option contract has gone away and we have the 29th option contract that's in there. All right. Now let's go back to the software and we're going to add to all of these positions. We took the cap position off that we were up about 30% on. Also sold a bunch of calls against it that expired. We're going to add to the Google position. So in this instance, we got the 105 strike call, 403 days remaining to the expiration date. The cost was $46, and right now the midpoint is at $37.58. So we definitely want to add to this position, and let's just trade. And we're not gonna close. We're gonna open. $105, $117 strike call option. So let's go in here, Google. 105, 117 strike call option. All right. And I think we're going to add a couple in this position. I don't know why the 1.6 is in there. Okay. So in this instance, we're going to add two more positions to this. So we'll have 3 options total inside our portfolio on Google. So we're placing an order to buy to open 3 contracts of the 105 call. Midpoint 175, we'll say we could fill at 165. So we'll say 37.75. 37.75. And we'll send that order to the floor. And send order long call Google 105 strike 117.25. Answer is yes. And we're filled on that. So now inside our portfolio, we will see that we'll be adding to that position in Google. Now, Nvidia. Nvidia is up about 14%. Our cost basis on this is 155 and it's trading at 178. So, and here we're going to add a couple more positions on Nvidia. We have a $200,000 paper trading portfolio, so it's time to start adding. We're going to go 117 expiration, 320 call. So 117 expiration and Nvidia, NVDA. Let's add 2 to that position. And in our portfolio stocks, Nvidia, the strike is 320. Options grid, we're looking at 320 here. And that expiration, and we're going to be buying. Let's go and add 2 to this position. So we'll have 3 total. 178.05, 170. Let's go 178.10, a little bit different than the midpoint. 178. So 178. We'll do 178.05. Okay, so we're looking to buy 2 of the January 17th expiration 320 strike call options. We're going to send that to the floor at a limit price of 178.05. Good for the day. And do you want to send that order? The answer is yes. And over here, we did see the fill again. So eventually that's going to show up in our paper trading portfolio. And we're going to have 3 of those. All right, let's add 2 more of the Schwab positions. So here we have it at 45, 103.14. Okay. So in here, we go to 45 on 117, options grid. 45 on 117, Charles Schwab, SCHW. Let's add a couple more to those, to that position. And so this expiration, and once again, we were the 45 strike. So now if on the Schwab position, we're on the 45 strike call option. We're deep in the money. We got a lot of intrinsic value if we're going this deep in the money. We're paying $20 for that position and we're at 99. So since this position has done really well, we have 1 call that's going to be going against that portfolio. And we're at 64 on the stock. I might move up a little bit more on this one. So I don't know if I need to get that deep in the money and get that delta, but it does help to keep your portfolio together and always buying the same option contract. But I just don't think that there's a need to get that deep in the money and put up that much capital to buy another option. So we're going to go back down and we're going to look at something right around a 90 delta. So right here, we have this option contract at 60, and this is trading at the delta of 93. I don't mind that. We're going to stay in the same expiration, which is, where's that 90? I guess I was not showing that expiration, but here's the 90 delta here. That's at 45. Let's clear this out. Portfolio 45, 117.25. 117.25, 65, 45 delta is 92, trading at $22. And that is that portfolio. So I don't mind hanging there. 22.65. Yep. So we can stay on that one. We were in the wrong expiration. The delta was way too high. All right. So we're going to, then it behooves us to stay in the same strike. And let's add 2 more to those. So we'll have 2 more positions. So 2025, 117 expiration, 45 strike call on Charles Schwab, SCHW, limit price of $22.65. So we'll say that we had to pay a little bit more than that. We'll go $22.75, give them a dime off the mid price, and we're going to send that to the trading floor. So send order for long call Schwab 45 strike 01/17/25 expiration, and the C is showing us that it's a call option, and boom, that order is sent to the floor. So now we are seeing our total position in that account. We bought 2 more of those inside the portfolio. They'll show up here in just a little bit. We'll have to rejigger that portfolio when it's all said and done. These are all of our orders and all of our fills here. So we filled on 2 of the Nvidia call options. Let me open this up a little bit. So we did Nvidia 320 strike call 117.25. All the expiration dates are 117.25. On Google, we did the 105. We got a quantity of 3 total in that at 37.35. And that one's still open. All right, so we're waiting for that one to fill. Nvidia filled, Schwab filled. All right, so this one is still open. So now if we go and look at Schwab, did that add it to our? Yep, now we see it in the portfolio. We see 3 positions in there. On the video, we see the 3. We need to get the Google filled. So let's work that order. Let's try to fill it here on the show. I'm trying to get 3 of these done at 37. Okay, so let's go in and right now we're going to replace this 137.25, 38. So let's go 38. Yeah, let's try 38. All we're doing is replacing the price, and we're going to swap it out. It'll be the same order going down to the trading floor, but now we're going to try to buy it at 38.10, and we'll replace that order. 38.30 is the ask. Yeah, we can do that. Are you sure you want to replace the order? It's asking me right here, and the answer is yes. And we'll send that to the floor, and we filled. Okay, so now we got all of our positions on. This is our new trading portfolio. We will add some more positions to this as we go along. Especially I wanted to add more into the Google trade than I did on some of the others because we are down a little bit more on that. And I do feel fairly bullish on Google going into the new year. One of the magnificent sevens. And that's underperformed the market. It's actually trading at probably one of the better PEs of any of the stocks except for Caterpillar, which we didn't. Did we fill on that Caterpillar? We should have already. Yeah, there it is. Nope, that's still open. And the Schwab roll is still open. All right, so I will adjust those and make sure that they fill today. And if I look at my clock, I see it as 11:30. So that's going to be it for this edition of Options Guy TV. I'm going to go in, make sure we get out of the cap position today. I don't want it to run too hard against me with that shorter term call option. And I will make sure that we roll our Schwab position because we don't want to be forced to close out that position. We'll come back on Wednesday and we're going to add some stocks. We're going to be looking at adjusting things so that we have kind of equal weighting across all those positions. And we're going to add a couple of more positions to that portfolio. And we're going to try to come back once a week and look at it and see where the calls are at and see where the short calls are at on the position. That's it for this edition of Options Guy TV. Please click subscribe, ring that bell, pound that thumbs up, and we'll see you this Wednesday for the next edition of Options Guy TV. Thanks for coming, everyone.